Hello, this is Gary Schnitke, and this is a 5-minute Farm Doc Daily dealing with risk for 2023 grain farm returns. We calculated break-even prices for corn and soybeans grown in central Illinois on high productivity land. We had a total cost of $1,228 per acre for corn, and that included $370 of cash rent and $858 of non-land costs. That $1,228 total cost results in a break-even price of $5.34 for a expected yield of 230 bushels per acre. If we get a price below $5.34, we will have a loss, and if we have above it, we will have positive income. We also included a margin of $75 per acre, giving us total cost and margin of $1,303, and at that level we have a break-even of $5.67. Calculations for soybeans results in $902 per acre of total cost. $532 of that are non-land and $370 are cash rent. Given a yield of 72 bushels per acre, we have a break-even of $12.53, and that break-even increases to $13.57 if we include a $75 per margin per acre. We also looked at the chances of having prices below that at harvest using a price distribution tool that's available on FarmDog, and that uses market prices to calculate probabilities using a Black-Scholes options model. The probability of being below $5.34 is 55%. Of being below $5.67, which includes a margin, is 66%. So those are both for corn. For soybeans, our $12.54 break-even to cover total cost has a 47% chance of having prices below that, and total cost per plus margin 69%. Those break-even prices and the probability of below those, there is a good chance that we will not cover cost in 2023. We also looked at crop insurance guarantees that exist out there. And for corn, if we purchased 85% RP coverage and looked at a cash guarantee, which takes into consideration that there is a basis and cash prices are below projected prices, we have a minimum guarantee of $1,097. We note that $1,097 is below our total cost. Similarly, for soybeans, 85% coverage level, we have $824 minimum cash guarantee, which is below our total cost. So even if we consider crop insurance, there are chances of losses, and relatively substantial losses, in 2023. We, however, don't believe there's likely to be large amounts of financial stress in 2023, even if we see losses on Illinois grain farms. First, crop insurance does provide downside price risk, and there's a stop-loss gap in there, and most farmers in central Illinois purchase high levels of RP. The break-evens that we calculated are for cash rent farmland. Most farmers also have owned land, which typically has much lower land ownership costs than our cash rent. That again provides a buffer, and also share rent land will not have the same break-evens we have shown here. Also, there have been high incomes in previous years, particularly 2022 and 2021, and farmers have built financial strength during those years, which can be used to offset any losses in 2023. Finally, there's a chance of ad hoc disaster assistance, something like ERP, which has happened in quite a few years since 2017, that program could be put in place for 2023. That would require additional legislation. Perhaps more important than this year is looking at next year, and we will have a clear view of prices and yields and returns in August or late summer of 2023. At that point in time, we will also have a better feel for what prices will look like in 2024. And we would suggest that if we see 2024 prices below $5 for corn and $12.50 for soybeans, that some serious thoughts to making adjustments need to occur, and that might even include, and probably does include, lowering cash rent. On the other hand, if we see prices between $5 and $6 for corn, $12.50 and $13.50 for soybeans, we're a little bit nervous, but we're okay. We're sort of on the edge there of looking forward and thinking about having losses in 2024. And if we're above $6 and above $13.50, have a great harvest season and a good Christmas, but remember to use variable cash rents going forward. You can read more about this in the Farm Doc Daily listed in the video description.